And today, taking the same weight forward, it's now time that we talk about something that I'm sure that every person here talks and thinks about. I believe that every successful company we see today, it started with a question and not with an answer. An idea that didn't have proof, but it had somebody who had a deep belief in that. And that somebody is called investor. Today, in this session, the investor's lens from early bets to scale, we're going to explore how investor thinks and evolves, from backing potential to building an enduring value. Now is the time that we deep down and we dive into this mindset of an investor. And to start this session, I'd first like to invite our host on the stage, the person who's going to help us moderate the entire session and bring your questions that are in your mind here on the stage. So I'd like to invite Mr. Ravi Modani, founder and CEO of One-to-One Finance Private Limited, board member of Factor Association of India, to please join us here on stage. A big warm welcome, sir. Welcome. I would now request our moderator to also welcome our speaker one by one, once I call them on stage, with a bouquet. So I would first like to invite our first speaker here on stage, Mr. Vineet Rai, founder and chairman of Aavishkar Groups, to please join us here on stage. Welcome, sir. I'm sure that we all are energized. I can already see it on the face. But the only way we can also, spread that excitement is by clapping, by having that smile on the face, and by letting our speakers know that we're equally excited to listen to their excites. Big warm welcome, sir. I would now like to call Mr. Mohit Gulati, Managing General Partner, TiE Growth Opportunities Fund, to please join us here on stage. Welcome, sir. Welcome. And now I would like to invite Mr. Arjun Vaidya, founder of V3 Ventures, to please join us here on stage as well. Welcome, sir, everybody. Welcome. I would now like to hand the stage to our moderator and looking forward to listening to the insights.
Hi, good morning, guys. Good morning on a very chilly winter morning in Jaipur, which is unexpected. So good, lot of warmth with the money on the table over here with three kind of investors. So before we just begin, let me just give you a brief profile of although they don't need any introduction, but still just to get the context setting. So Vineet has been the founder and chairman of Aavishkar Group, which manages more than 11,000 crores across 9 funds, out of which 7 are domestic and 2 are overseas. They are the leaders into Global South. He has been awarded TiE Global Award. He's been Ashoka Fellow. He has been a key for the investors into multiple small finance banks from Suryoday to Utkarsh, across many other things. And one of the key philosophies which I was going through is they say they solve problems worth solving. So that is something which will pick up his brain during the day, during the session. And then we have got Mohit Gulati, who is the managing director of TiE Growth Fund. The focus is founder first and managing almost 250 crores on the fund. On the group level, they have almost like $2.5 billion under AUM. He's a key angel investor as well, putting his own money first. Then we have got Arjun Vaidya, who is the founder of V3 Ventures, part of Verlinvest group, and early stage customer-centric, technology-driven businesses. That's what he looks into. He's been a successful D2C brand as well. So welcome to all of you to Jaipur and this to TGS, this session about investors' lens from early bets to scaling, right? So when you talk about lens, then I was just speaking about the photography in terms of Instagram. So what you see on the Instagram is the output, right? On the input piece behind the lens, there are so many things that are moving components which formulate the entire picture, including the aperture, exposure, ISO speed, and so many things. So we'll get get going and talking about that more as well, what goes behind that. So my first question, I'll put it in a frame because all three of you come from a very different investment portfolio sizes, focused, customer-centric, founder-first, and problem-solving, right? But at the end of the day, you are investors. So when you look into a business or a startup, do you change the lens because of the money which you have got in terms of investment size or your thesis, or the risk assessment is primarily same across all of you? So I'll start with Vineet and then Mohit and Arjun as well. Yeah.
Okay, first, thank you. मैंने अपना 9th, 10th, 11th, 12th इस city से किया था, so, and this is the first time I'm actually speaking in Jaipur, so thank you for having me here. I think risk in investing actually remains the same. It doesn't matter when you are investing because there are many other variables. Some of them are controlled by the entrepreneurs, some are not controlled. So the uncontrollable variable continue to influence all kinds of investment. But as an investor, you can only look at what you can control. And there, 3-4 things matter. The geopolitics is very important. We know what is going on across the globe, but the geopolitics of technology, how it is evolving, etc. For example, we have heard a lot about AI. India probably is 4 years behind the global AI revolution. So we are investing in AI. Not that the entrepreneurs were not there, but we are investing now. So in some sense, when you start looking at entrepreneurs, you have to understand where India stands, where the world stands, where the pools of capital are going, where you have raised your money. So have you raised dollar or rupee? And those things make a significant difference in how you make your choices. Ultimately, for an investor, it is not an individual company, so it doesn't matter. So when we look at a company, we try to construct a portfolio, and that portfolio, where it is coming from, what kind of portfolio it is, and how would you liquidate that portfolio plays. So for example, if you are looking to return 5x to your investor, the portfolio construction will be radically different from when you are trying to return 3x or when you are trying to return 10x. All the three portfolio construction will be very different. The quantum of risk that you will take will be very different. The quantum of capital that will go into will be very different as well. So it's very important to understand, and therefore each one of us have to be clairvoyant or vision tellers, because we are effectively creating a portfolio and not an individual company. All of us will have 10, 20, 40x returns in some company, but I can tell you it does not deliver any significant value to the returns you generate on the portfolio.
Very interesting. We always thought it's a company, but it's a portfolio management as well. Yeah. Wait.
No, I think, Ravi, I'll take a slightly different view here, right? You know, your ability to look at entrepreneurs and gauge them keeps changing year on year. As you spend more time doing this, you keep evolving your style of looking at people, your methodology. When I started my journey in 2012, you know, the first transaction I did was Ecom Express. We had a 1.5-page document which we called the SHA. There was no other legal document. At that time, I used to trust, so remember these words, right? I used to trust everyone until proven otherwise, which means I trust you until you break it. 13 years into this, I trust nobody until proven otherwise. You have to earn your trust. I think there is, in this Instagram world, right? Question everything that you see. Because behind every shiny photo, there is a lot of smoke screen, there is a lot of hogwash at the back. Founders, investors, all of us, we are all hogwashing our way to the top. So please ask questions. For founders, you know, please be cognizant of the fact that when you come and say, I am a third-time founder, I've done this, I've done that, all it takes me, for all of us, we have subscriptions to platforms which give us your Jaram Patri. But for even average Joes, 109 rupees MCA gives you a detailed breakup of what you did in your past journey. So stop faffing. Same thing with Instagram. For the ones who are flaunting their cars and all of that, you will see if their ITR and GST matches with that income, and either you or Nirmala Sitharaman, one of them will catch it out in the open. You know, I was speaking to Fadi last night, right? Fadi is the Aramax founder. And he, you know, he funnily in English told me, ki in the hammam, everyone is naked. And I said, boss, this is a Hindi saying, ki hammam mein sab nange hai. So that is the true story of where we are. While we manage funds, unfortunately, it's our job to, you know, because it's fiduciary responsibility, it's our job to decimate, go deeper down and see the integrity of founders. Once we get integrity right, everything else sort of falls in place. And like Vineet said, your outcomes will vary depending on what you're doing. In fund one, you're trying to go for big bets. In fund two, you are like Ravi, you just want to play defensive. कि बस जिंदा रहूंगा तो फिर कल वापस आ जाओगा batting पे. By fund three, you're like an all-rounder. You can play the whole thing. So Vineet is, probably on fund four, fund five, fund nine. So he's played the entire cycle. He owns the IPL. Arjun and I are still sort of learning the trades here.
So what do you, Arjun, what's your view on that?
Yeah, I'll maybe speak a little bit less scary than Mohit, because now I'm thinking कि मैंने Instagram पे क्या post किया और मोहित ने क्या देखा है.
In fact, somebody asked me before the session, he's the same guy who's very active on Instagram, by the way.
Yeah, now I know. I don't know if I should be or not. Look, I think the core of the question you asked was, if you're investing smaller amounts, does your thesis change? And if you're investing larger amounts, does your thesis change? And I've not been in this business for as long as either of them. Right? I'm investing for the last 3.5 years. Before this, I was a founder of a D2C Ayurvedic products business, so in a very different world actually. I started as an angel investor. I had some money I made from exiting my company. And so my wife and I decided that we'll put 5 to 15 lakh rupee checks in as many companies as we can to give back to the ecosystem that gave us an outcome before the age of 30. And so we started investing some money, we started backing some companies. But that thought process was a very different one, right? It was a thought process that came from, hey, we're going to give back to this ecosystem, we're going to invest smaller checks, and we're going to invest in more companies. So I like to explain at least venture capital investing with a dartboard, and you're throwing darts going for the bullseye. And I had, with my angel portfolio, now I've had 150 darts to throw, right? I've invested in 150 companies. So I've had 150 darts to throw. Because of that, you get the ability to take a little bit more risk, invest in those sort of moonshot ideas, and my dad's friends sometimes ask me that, hey beta, आप ऐसे companies में invest कर रहे हो तो हमारा भी थोड़ा पैसा लेके डाल दो. So I tell them, I will only let you invest in what I let my dad invest in, which is not a punt, it's not a moonshot idea, it's something that will give you sort of more stable return. Now, 3.5 years ago, I started a VC fund. We are actually in the process of starting our third fund now. So we've seen some amount of cycle, but I would say not enough. In each fund, I have only 10 darts to throw. And so when I throw those 10 darts and we're putting $1, $2, $3, $4 million in a, let's say, $30, $40 million fund is what we operate out of in each fund cycle, I have to be a little more sure. But then, as Mohit was also talking and as Vineet was also talking, I take less risk, and so my upside is also capped to some extent. Right? I'm investing in a, let's say for example, we just invested in a protein snacking business called Super U. The business is doing already some 200 CR in sales. We have paid some 500, 600 crores in value for that company. Can that company become 20,000 crores in value as a protein snacking business? Probably not. But is that company going to go to zero? Also probably not, right? So I think depending on whose money you're investing, what your responsibility is to that person. If I lose one investment of mine of 10 lakh rupees, I have to answer to myself. Yes, I'm very unhappy about it, but I have to answer to myself. If I'm investing Mohit's money, then there's a lot more risk. But let's say I'm investing somebody else's money, I have to be very sure about where that's going and treat it more responsibly like my money. So I think depending on the quantum as well as what the purpose of investing, the structure and style of investing is also different.
Well, you're right, absolutely. We're talking to Mohit right now, just before the session. And the angels are basically putting that tan, man, dhan, all three components. So probably at the angel piece, the tan and man is also much more important than the dhan as well. Because maybe the dhan is smaller than the tan and man, which is like, being committed to the person, right? So that's the interesting piece. Another coming question connected to that as well is, today people are thinking about business building versus cash burning. Right? Of course, the things are changing now, and we see startups also getting matured. But that is a context, because until you scale up, why do you need money for? That's the question. So this question again starts from the larger, different perspective from Vineet to Mohit and then Arjun.
So I think what you have in India is like we make everything. हम सब चीज़ों को मिला देते हैं तो सब्जी बना दी हमने खिचड़ी बनाया हुआ है. So venture capital, pure venture capital is about dominance investing. It is not about how much money you are losing. It is actually about dominance and dominance at scale. For you to gain dominance, either you have to disrupt a technology or you have to change human behavior. Either of the two things are critical and important. When you invest for that, you have to invest behind a conviction and you have to invest very large amounts of money. In India, while we are taking dart-based risks, but we are not putting significant amount of capital behind those darts. So therefore, India has yet not seen very large bets behind wild ideas. We have yet not seen. Most of us in early stage are putting few million here, there, 5 million, 2 million, 3 million. I think we have at Aavishkar thrown 5 million at absolute crazy ideas. But I don't think so anybody has gone beyond 10, 15 million. So I've not seen anything in India. While in US, people will go to billions behind that. For the simple reason that if you look around, anything which does either human behavior change or technology disruption, pretty much the first two companies take the 90% of the market. So if you are in third, fourth, or fifth, it creates no value for the fund. And that's why venture capital is purely dominance investing. It is, you get your unit economics right, or you get either of the two theories right, then you will outscore. And therefore, if you have 80% failure, it's okay. India is not investing like that. We do not, because we are guys who are trying to balance, and we are constantly balancing. That means we are not really pure play venture capitalists. That's one part of it. The second part is private equities, where you again think and invest in a very different manner. But I just want to stop here.
How about you?
So I think, it's always difficult to sort of top up on Vineet, right? There's so much more experience. I think it's Arjun and me combined together is equal to one Vineet. So we are going to do like this team and, Vineet alone. But I would just sort of disagree a little bit on this, because what I'm seeing in 2025 is a very interesting piece, right? While absolutely agree with what Vineet is saying, that market dominance, which comes in via years of cash burn. For those of you who've not seen Amazon, right? So Amazon got listed in the early 90s, had 48 quarters of losses before it turned positive, and it is what it is today. Can we create another Amazon today? Probably not, right? But that said, for disruptive businesses that are getting created today, there lies a very interesting second mover advantage for larger players. Meesho is a great example of a second mover advantage on Snapdeal/ShopClues. I'm guessing for the younger audience here, you have not heard these names, but way back in 2011 to 13, 14, ShopClues and Snapdeal were the big boys, right? They essentially are what Meesho today is. Both of them have shut down. Meesho came in at a time when there was that void in the market, was able to strategically raise capital and build out there. I think it's going to happen in quick commerce, right? While Zepto was the pioneer of 10-minute delivery, mark my words, by 2030, you will see large players like Flipkart or Reliance or Amazon or all three of them owning this space way more than Eternal, Swiggy and Zepto put together. So while there will be a lot of cash burn, you have to create an unfair advantage for yourself, some competitive moat. Only then will you be able to maintain market leadership and justify the cash burn to get there. But if there is no unfair advantage that you have or some secret sauce or moat, then you stand the risk of sort of getting disrupted. So cash burn versus dhanda, both are justified as long as you have end goal to reach on each of them.
But you would be having the least amount of cash burn in D2C brands, Arjun? What's your...
Yeah. So that's what I was going to talk about. By the way, I don't know if... and it'll be interesting to see what plays out by 2030 in the quick commerce race. I don't know if the big boys will actually take it or not, but it'll be interesting to see, and I'm going to keep that in mind and discuss it with Mohit 4 years from now. Look, I think I invest in two kinds of businesses. Right? I invest in what we call D2C consumer brands, which are brand businesses, which are actual real P&L businesses, which have a gross margin, a contribution margin. We look for a bottom line profile or the availability of a bottom line profile at some structure, some period of time with repeats, etc. All of that. And that's very similar to the business I built, right, in Dr. Vaidya. So you can't go burn 100% for 5 years in a product that's selling Ayurvedic medicine, or I can invest in a ice cream business or a plants and gardening business or a personal care beauty business. You can't do that, right? But we have, let's say, two founders of very, very large, successful platform businesses, right? We have Akshay from Shiprocket and Prashant from 1MG. These are businesses that actually were disrupting consumer behavior and were building consumer platforms. I've invested, let's say, for example, in Kuku FM. That was the first investment that I did from my fund, V3. In those businesses, they don't follow the direct consumer brand P&L profile. They're changing consumer behavior. They're creating platform behavior. They have deep levels of repeats in B2B or B2C. And so in those kind of businesses, you have to allow for the business to get the amount of capital it needs. Like when we go back and we say, hey, could Kuku FM be built in $2-3 million? No. By the time I invest in the business, they've already spent about 100 CR and they spent another 300 CR. Today, the business does northwards of 150 crores a month in sales and is a profitable business. But it took a journey, it took its time, etc. all of that. So depending on the kind of business you are investing in and what that business is trying to do, you will have to see how much cash burn is allowed, right? And I think the other thing is, every business has cycles, and so our world of startups also has cycles. And the moment there is a downturn, what they call a funding winter, there is some scam, there is some startup that shuts down, the traditional people like my dad come back and say, I told you, this cash burn stuff just doesn't work. It's totally wrong. That model may work in the US, but it doesn't work in India. But I think that if you do it responsibly, and there are people who have done it responsibly, there'll always be bad apples, but there are platform businesses that need to burn some amount of money to change consumer behavior. And we've seen enough examples now in the decade-plus cycle that we've had in India to show that outcomes can be created.
Very interesting. So, Jaipur being a tier 2 city, and we were talking yesterday also in the evening with Mohit as well about Ludhiana, there was an example, right? So, tier 2 cities, people make a lot of money, they are EBITDA positive, doing a 25% year growth or whatever it is, doing good market share, doing great work. So the question here is, and it's all on the minds of our members as well, should we dilute? Should we raise capital? If we are making good money, growing fantastically, what is your advice to the entrepreneurs, the traditional businesses? What should they do,
So the first thing is never give advice to a person who's running their business. It's a very bad thing to do. The person has to make a choice. Life is not that easy with an investor by your side, and you need to really understand why you are bringing in capital. A lot of people don't understand and then burn their fingers when they bring in capital. There are all kinds of investors this side. There are investors who are young, nervous, who have not seen many cycles, may not have the appetite to see things change. There are some people who are nosy. So people like us, we're very, very, very nosy. We actually try to get right corporate governance. We will question everything. We will not just sit there and nod at what you say. So I spend a lot of time educating my entrepreneur to not take my money, because I know that at that point of time when they're interacting with us, they want the money and therefore they will accept everything. But within the moment, and my mentor was a gentleman called Vishnu Varshne, who set up India's first fund, GVFL. And he told me, Vineet, there is a theory called God and dog theory. Till the time you sign the check, you are a god. The moment you finish the signing and you hand over the check, you become a dog. The problem is not that you are a dog. The problem is you're a dog that can only bark, not bite. So really the reality of people like us is, first we are Begani Shadi mein Abdullah Diwana, somebody else's money we give to somebody else, and then claim credit for everything. That's one thing. The second thing is that we are basically a dog that can only bark, not bite. So at Aavishkar, we are actually an impact investor, which means we are very nice guys on the face of it. But a lot of entrepreneurs will vouch that we are not nice guys. We are very difficult once we get in. But we are not difficult to the entrepreneur. We are difficult because we want to make sure that the entrepreneur makes a lot of money. Unfortunately, in India, a large number of entrepreneurs don't want to make money. Their ego outruns the desire to make money. And invariably, and I'm seeing it constantly, and I'm saying it because I have made 100-odd investments in reasonably large companies. So we have seen entrepreneurs running out of steam at 100 crores. That means they believe they have already arrived. I have seen entrepreneurs run out of steam at 500 crores, at 1,000 crores, 1,500 crores. Each feeling that they have done enough, that they now deserve credit for everything that they are doing. So they don't want to be in these conferences, give gyan to people, not necessarily think about how to take 1,000 to 5,000. Remember, if you're doing that, there is no way you will have time. So I think a lot of us need to understand why we are in the business. You are happy at 100 crore, why take somebody else's money and then have a nosy guy making your life miserable on a daily basis? On the other hand, if you really want to go from 100 to 1,000, probably is a good time to take money. The third, you want to get out, sit on cash and enjoy life and look at others and pass comments. मैंने को तो मालूम था ये होने वाला है. That's the third way where you exit. And I think a large number of founders in India have made the wise decisions of cashing in when the cycle is on the upside. All the three things are fine, but you need to know, and the choice is always yours. So my advice is, you have a hard talk to yourself and then make your choices. Don't go by what financial influencers or people sitting on stage are saying.
Mohit? See, this is the problem, right? Like, there is nothing that we can top this up with. But I think, historically, if you see, there's a Hindi saying, right? Takdeer ko kar buland itna ki khuda tujhse puche bol bande teri kya raza hai. So if you're building a business like that, where you don't really need the capital, you're happy making you mentioned 20%, 25% EBITDA margin. Trust me, you will have all of us on this panel and 100 others like us coming to your doorstep and saying, please take our capital. While we can, say all the checks and balances, like if Nitin Kamath opens up his cap table and says, I'm open to subscription from venture capital funds. Trust me, none of us are even going to do a DD, we'll just go flogging with our checks there. So that is the kind of business that you have to build, right? If you can build a business which is going to be large enough and is going to attract a lot of capital without you having to upsell. Remember in life, whether it is investors or women or luxury cars / homes, the more you chase them, the further away they go. Just when you let go and you say, okay, I'm very happy and content with the wife in my house, the capital that I have or the business I have, you will find ways that keep getting disrupted in your life. So please don't be in the rat race of chase. Do not, peg yourself with influencers, with XYZ. I think Vineet is very right in saying that we are limiting our thought process with a number that is pegged to it. If by that logic, Elon Musk should have retired 10 years ago, right? He's worth like 400, 500 billion now. I mean, more than that. That number is not even consequential anymore because he stopped looking at that number. I'm sure he doesn't care. Why are our entrepreneurs so obsessed with that number of, this is my net worth and this is for all of you who are worshipping Shark Tank, and I know Arjun is doing a junior Shark Tank. For all of you who are worshipping Shark Tank, the founders are spending more time flaunting luxury cars themselves, being panelists versus anything else. So please stop running behind the wrong things. Look at the bigger picture, which is impact, which is building out great businesses, which will stand the test of time. 25, 30, 40, 50 years from today, you and I probably will not be alive to see things around. What is the legacy we are leaving behind for our children? What is the kind of India that we're leaving behind? That will get determined by what we start today. So please start building right.
Arjun, your views?
Yeah, I think, look, I'll speak from personal experience, right? When I started my business, I was 24 and a half years old, and I had worked in private equity before that. My first job out of college was in a private equity fund. And so when I started my business, for some reason at the back of my mind, there was always that dream and that goal that एक दिन मैं funding उठाऊंगा और Economic Times में article आएगा, right? And I was always just gunning for that. And it was really hard to raise money for me. It took 2.5 years and 75 failed conversations to get there, and we needed the money. So it's not like we raised it for that Economic Times article. But that whole notion just is wrong, right? Why is it wrong? Because it leads to disappointment. It's not easy to get money from investors. But the reason to raise money is not the Economic Times article, the fame, the getting invited to conferences, the being the cool entrepreneur, LinkedIn featuring you as the top 20 places to work in India, etc. That's not the reality, right? See, I think that, and I am also to blame that I've gone also on a ZTV show that glamorizes funding, etc., all of that. But the reality is that we've glamorized it over the last 5 years. But I'm very honest and clear that there are lots of businesses that don't require our money. And I'm very, very upfront to those entrepreneurs, including my father, to say, do not, right? Why? My dad has been running a luxury jewelry and watch business for the last 45 years. He's a reasonably successful business person. He has a medium business. He brings home PAT every year. But he hates advice. And he hates people telling him things, right? I was this 23-year-old private equity analyst. He would show me his P&L and I'll be like, gross margins down this quarter. And he's like, what do you know? Have you ever run a business in your life, right? And so I think raising money comes with a lot of strings attached. I like to say that it's not a marriage, but it's a very, very long-term, serious live-in relationship that you have to have with someone who you have to have breakfast, lunch, or dinner with once a month for the next decade, but also speak to them on the phone a couple times a week, right? And so that vibe has to match. But also, you may be happy walking on your treadmill at speed 6 or 7. When the investor comes in, you will be forced to jog or run between speed of 9 and 15, depending on what you've committed to them for. If you are on for that ride, which I personally was on for that ride and I wanted to run at 15 and get to that goal, great. But if you're not on for that ride and you are on a treadmill that's moving at 15 and you can't reduce the speed, it's a disaster, right? Absolute disaster. So if you're running a good business, and there will be a lot of people in this room, and I've met a lot of people from Jaipur who do that, there's no shame in saying, I'm not going to raise any money. Actually, you guys should be the guys who are funding us and giving, I don't accept external LP capital, but a lot of funds do, and these are the kind of people that become the best kind of LPs as well.
Great inputs. So we are just at the end of the time. Just a quick rapid fire questions to you guys. The first would be the X factor. If you had to marry one portfolio company, date one competitor startup, and ghost to one sector forever, which would they be? I'll repeat. If you have to marry one portfolio company, date one competitor's startup, and ghost to one sector forever, which one would that be? 10 seconds before the LP's call. I'll repeat again.
We have to give 3 answers.
Yes. Marry one portfolio company, date one competitor's startup, and competitor startup, and ghost one sector forever. Ghost.
Okay, so I'll marry all my financial services companies. They are reasonably consistent. They are standing by you, giving you 3x return. Sometimes they give you 5x. They will never give you 10x. They also rarely give you 1x. So they are like wives. Marry. Competitor, well, there are lots of competitor startups that I would like to marry, but I like to date actually.
As well.
But since I'm already married, so I'll let it pass, frankly. And then
Ghost
the
sector.
that I'll ghost. So anybody who says I'll ghost a sector doesn't understand destiny. So I, for a very long period of time, was not looking at AI at all. And then I'm going to be actually making a fairly large, significant investment from our portfolio next month. So really never say that, because you will have to eat humble pie very quickly on that. Remember, we don't invest in a business or an entrepreneur. We also have to understand if that space is going to attract significant amount of capital. India's this year, 50% or more than 50% of the capital has gone into AI. World over, it's the same. So if you're not going to be in that space, you unfortunately will not have a company that's going to run out. And capital itself is a moat. So it doesn't matter how deep tech you are, how smart you are, how powerful you are. But if you have capital by your side chasing you, that itself is a very powerful moat.
No, I think
Marry, date, and ghost.
I would marry all the employment generating companies from our portfolio. So BVG India, we employ 1.1 million people. For all of you who've landed at Jaipur airport, the guys who clean the airport, BVG India. Ecom Express, Grab, all of them. I think it just gave me immense pleasure in seeing more people getting jobs, because that just changes outcomes a lot for families, right? Date a startup, I think Shadowfax. Shadowfax was our direct competitor for Grab before we sold to Reliance, and then Shadowfax, of course, did really well. I absolutely love and admire those guys. and like Vineet said, I think the world's too small. It's very hard to say I'll not do this, I'll not do that. We've all made mistakes where for me, I had my mind closed around deep tech for some time, right? I said, deep tech in India is very hard to build, cycles are too long. But now with the RDI fund coming, honestly, I'm changing my PPM and saying, bhai, main bhi deep tech karunga. So, that's just the truth of life.
Yeah, I'll keep it short. Marry one company, it'll be Cuckoo FM. It'll do well for us as a fund, and we'll make nice returns. But it's changed a lot of people's lives, and so that's the company. Date one competitor company. Actually, I was always inspired as an Ayurveda entrepreneur by Himalaya. It's a company that doesn't talk much, but is truly an Indian company that's gone global, sells in 80 plus countries. So, I mean, always impressed by them and continue to be impressed. And goes to one sector, maybe it's lack of knowledge, maybe it's my ignorance, but there was a lot of weird stuff happening in crypto in 21, 22, and a lot of wrongdoing by startup founders as well. So from that time, I got a little bit scared. There are a lot of people who made a lot of money and understand it better. I just don't.
So one last word, AI-powered hypergrowth disrupting the ecosystem. Which one will you remove from the term sheet? AI-powered hypergrowth and disrupting the ecosystem. Choose one of them.
So, see, I think
Single one of one.
None of the three things actually feature in our term sheet. Our term sheets are very bland, and we don't go for jargons. We simply take out every jargon that. So if somebody comes and tells me I am AI ML, we basically let the founder go very quickly, because the guy doesn't really understand what he's saying. So our term sheets don't carry any jargon. They carry a lot of legal jargon, but nothing on these kinds.
For us, it's just people powered. Once you get your people call right, all of these things will fall in place.
Yeah, I think AI powered is being misused a lot, right? If you're making ice cream, your supply chain and backend can be AI powered. But if you tell me you're AI powered ice cream company, again, I invest in very standard, traditional, boring businesses, growing plants, making ice cream, doing backpacking hostels. So yeah, if you misuse, if you misuse that term, then it doesn't make sense, right?
Great. So a great perspective from three of you. One covering a wide angle, one a macro lens, and another tele-zoom lens, right? So different perspective and different thought processes. Thank you so much. It's was great talking to you. Thank you so much. A big round of applause from the panelists. Thank you so much.
Thank you so much, sir. I'll also request now our moderator to give a small token of thanks and felicitate our speakers as well. I must say it was a very interesting session, and you all must have got a deep insight of how the mind of an investor thinks. And also a big thanks to our moderator for actually asking the questions that help us steer the entire conversation in a very meaningful direction. So thank you so much, Mr. Arjun, for sharing your insights with us. Thank you, Mr. Mohit, for sharing all the insights and thought-provoking ideas you shared here. Big gratitude to Mr. Mohit for Mr. Vineet for coming and sharing all the thought-provoking thoughts. So once again, a big thanks to all the speakers. Ladies and gentlemen, let's hear it up for the speakers for the day and for sharing all the insights, for taking out time from the busy schedule, coming here, traveling all the way, and ensuring that we get the ideas here. Thank you so much once again. Thanks.